Hey YouTube, welcome back to another video. This is my financial focus, and in this video I'm going to be doing an intrinsic value analysis of Disney. I'm going to start off the video by doing a quick business overview and figuring out how the business makes money, as well as look at a couple of different segments of their business. Then I'm going to go into their annual report and peer at their financials so that we could get a better understanding of their financial health. And then I'm going to finish the video off by using this Microsoft Excel discounted cash flows model to figure out what a good buying price would be for us from a value investing perspective based on the business's current cash flows. So the first thing that we have to understand about Disney is that it's a pretty big business with a lot of different business segments and revenue sources in different areas of the global economy. To start off, Disney owns about 80% of ESPN, which essentially is made up of everything from college sports, the NBA, the NFL, MLB, US Open tennis, the PGA, WNBA, Wimbledon championships, Masters golf tournament, Top Rank boxing, as well as a couple of different soccer rights. They also own 73% of National Geographic, which is basically a network that focuses on science, natural history, adventure, and exploration. They also own Hulu, which is a streaming service that pulls in revenue through a subscription-based business model. And then obviously they have their world-famous Disney World and Disneyland resorts in Florida, California, Hong Kong, Shanghai, Tokyo, and Hawaii. And the revenue from these different theme parks come from admission ticket sales, as well as sale of merchandise, sale of food, drinks, and also room nights at hotels. And then they're able to collect royalties by licensing out their brand as well as their merchandise. They also own Disney Cruise Lines, which is basically just a gigantic boat that people can take their family out on vacation every now and then. But this sector of their business, as is not hard to take a guess at, has been hit pretty hard by the global pandemic, but we'll get into that later on when we look at the business's financials. Also, they own Broadway. Well, not all of Broadway, but they own different very popular Broadway theatrical performances like The Lion King, The Little Mermaid, Aladdin, and Mary Poppins, to name a few. And they also own different characters that they use to license on the market, like Marvel characters from the Avengers, Star Wars, Spider-Man, Toy Story, Winnie the Pooh, Disney princesses, as well as their classic characters Mickey and Minnie, as we can see right here. And then lastly, they also own a pretty substantial part and operate ABC television network, which is affiliated with 240 television stations, reaching almost 100% of US televised households. And the revenues from ABC primarily consist of advertising sales as well as affiliate fees. And then lastly, they also operate and own Jimmy Kimmel Live, which is a late night television show that basically just is Jimmy Kimmel being himself on the internet, basically. So as we can see, they own a lot of different areas of the global economy, and because of that, they're able to pull in revenues from a lot of different sources, which obviously from an investing perspective is a great sign, because it's always good to see a business that, like Disney, has a really strong brand and also has such a strong grip over different areas of the economy, which provides them a really good moat that makes it harder for their competitors to compete with them. So now what I'm going to do is look into their annual report and get a better understanding of the financial health of Disney. And the first page I'm going to go to for that is page 44. So right here, this is just a quick little chart that breaks down Disney's revenues by their business segments. And we can see that in 2019, the largest revenue stream in their business came from their Disney World and Disneyland resorts. But obviously, because of the global pandemic in 2020, that area of their business was hit pretty substantially, decreasing by 37%. But that being said, we can see that their direct-to-consumer and international segment of their business increased by 81%, and their media network revenue also increased by 14%. So they did experience a 6% loss from their total revenues from 2019 to 2020, but because of the shift that they made earlier on to launch their Disney Plus services, they were able to weather the storm of the economic shutdown a lot easier, which probably wouldn't have happened if they didn't previously invest heavily into Disney Plus. So that was a pretty lucky move for them. And then we can see right here, this is just the operating results from the media network segment of their business, broken up by the different revenue streams for the media networks, most of which comes from affiliate fees and then advertising, and then it's broken up, as we can see here, from TV, SVOD, distribution, and other, which is their second largest source of revenue for their media networks in 2020, which also grew by 58% from 2019 to 2020, making the total revenue from their media networks about $28 billion. So next page that I want to look on is page 45, and right here we can see that this is their revenue broken up a little bit differently in their media network segment. Instead of looking at like how they're generating their revenues for the media networks, they're looking at their different media networks and breaking it up that way. We can see that for their cable networks, they were able to bring in $17 billion worth of revenue. And then for their broadcasting segment of their media networks, they brought in about $10 billion. And then on page 46, we see their revenues broken up by their parks, experiences, and products. In other words, their Disney World and Disneyland resorts all over the world. We can see that this is definitely down from 2019, down 46% for their theme park admissions, and also down 42% for their merchandise, food, and beverage sales. And then their total revenues for October 2020 for their Disney World, Disneyland, and also their merchandise, licensing, and things like that came out to be about $16 billion. Next page I want to look on is page 48. And right here we can see this breaks up their Disney World and Disneyland and parks and experience revenue by their location internationally. And we can see that domestically from the United States, that's where the majority of their revenues come from. But obviously that's down because of the global pandemic that struck in 2020. Next page I want to look at is page 50. And right here we can see this is their direct-to-consumer and international segment of their business. And this part of their business is made up primarily by Disney Plus and Hulu subscriber growth. And we can see that the subscription fees that they brought in increased quite a bit, above 100% from 2019 to 2020, mainly because everybody was at home, and so they ended up just subscribing to Disney Plus and Hulu to pass the time. So that was a pretty strong influx of cash flow for Disney's overall business. And then their total revenues from this segment of their business increased 81% from $9.3 billion to $16.9 billion in 2020. So right here on page 77, we can see this is their income statement for their overall business for the years 2018 to 2020. And we can see that from 2018 to 2019, their revenues increased quite a bit from 59 billion to 69 billion, and then declined in 2020 down to 65 billion. But from 2018 to 2020, they're still up about $6 billion total in revenue. And then right here, we can see their net income in 2020 was actually a net loss of $2.4 billion. which is down from net income of $11.5 billion in 2019. And that was also down from net income of $13 billion in 2018. So their bottom line has definitely been decreasing over the last 3 years. Next page I want to look at is page 79, which is their balance sheet. And we can see right here, pretty interestingly from their balance sheet, that their cash and cash equivalents makes up a pretty small portion of their total current assets as well as their total assets. Of their total current assets, only $17.9 billion of the total $35 billion is cash, and most of their total assets is long-term assets. And so of their total assets of $201 billion, only $17 billion of that is cash, and most of these assets are held in the buildings, attractions, and equipment, probably from their Disney World and Disneyland results that they have listed here on their balance sheet, which comes out to be about $62 billion total for their assets, with the second largest item being goodwill. So that comes from things like business acquisitions. Then right here from their liabilities and equity section of their balance sheet, we can see that the borrowings that they incurred for 2020 were pretty substantial. They're holding about $52 billion worth of debt on their balance sheet, which is quite a bit more than the amount of cash that they have on their balance sheet. Sometimes businesses have a strong cash ratio, which is basically their cash to their current borrowings, which in this case, I guess, Disney does have more cash than their current portion borrowings, but of their total current liabilities, they have more current liabilities than they do cash. So in order to cover the payments on their liabilities that they'll be paying back within the next year, they are going to have to either cash in on their accounts receivables in order to cover that balance, or they're going to have to sell some of their other assets in order to make ends meet, or they're going to have to refinance their debt in some shape or form. So it's usually not that good of a sign to see that a business might not be able to meet their obligations in terms of current liabilities. But in the case of Disney, they obviously have a lot of assets that they could sell to meet their current liabilities. And this isn't that big of a difference from 26 billion to 17 billion. And then also, most of their liabilities are made up of long-term liabilities. We can see that their total liabilities and equity, after we add in their equity of 88 billion, come out to be the 201 billion, which is equal to total assets. That's why they call it the balance sheet. But that being said, a lot of their business is definitely on their balance sheet held for the future as opposed to within the next year or so. And then right here we can see, because of the amount of debt that they hold on their balance sheet, which increased from 2019 to 2020, we can see their total equity dropped from 93 billion down to $88 billion. Lastly, right here, we see their cash flow statement, which is the last financial statement that I'm going to look at before doing the intrinsic value analysis. And we can see right here that their cash from operating activities actually increased from 2019 despite the pandemic. But that mostly came from what looks like a lot of income taxes that were paid in 2019. And then even despite the low amount of income taxes that Disney paid in 2020, they were only able to increase their cash flows from operations by about $1 to $2 billion. From investment activities, we can see that in 2019, they spent a lot of money on acquisitions, and then they spent a lot less money in 2020 in terms of investing because they didn't acquire any companies in 2020. And then from their financing activities, we can see that they borrowed quite a bit in 2020, looking at about $18 billion in borrowings. In 2019, they borrowed more, but they also paid back more, so it sort of canceled out. But in 2020, they definitely just borrowed more and didn't really pay back as much. And so that ended up being a pretty big cash inflow from their financing activities of $8.4 billion. And so because of that, the cash at the end of the year that Disney had increased from $5.4 billion in 2019 up to $17.9 billion in 2020, most of which is financed through debt. So now what I'm going to do is look at the discounted cash flows model to figure out what a good buying price would be for us to buy into Disney if we wanted to invest in it from a value investing perspective. So the first metric that I'm going to use is the growth rate for years 1 through 5 that analysts expect for Disney. And I got that from Yahoo Finance, just from the analysis tab in Yahoo Finance for Disney. And we can see it comes out to 37.84%. For the next 5 years after that, I'm just going to be conservative and cut that percentage in half at a 19% growth rate. Then for the year 1 free cash flow, I got that from TradingView, just by going to the cash flow section in the Disney financial statements for TradingView and scrolling down, and we see that that comes out to be about $1.99 billion. Okay. And then for net cash minus net debt, I got that from Yahoo Finance just by going to the statistics tab. And we can see right here they have about $15.96 billion in total cash, and then total debt comes out to be about $58.31 billion. So at the time that we're starting off our analysis, they have a net negative amount of cash on their balance sheet. Stock ticker is DIS, and then shares outstanding is 1.82 billion, as we can see right here. And after plugging those values in, we see that the intrinsic value for Disney comes out to be about $67 billion. That's after adding all of these values, which is the cash flows for years 1 through 10, as well as what we would theoretically sell the business for in year 10, which is just 10 times year 10's free cash flow. That shows us the present value, and then we subtract the amount of debt that's on the business when we start our analysis. That puts the intrinsic value at $67 billion, and then we divide that by the shares outstanding, and that gives us an intrinsic value per share of about $36.86 per share given these growth rates. And based on that analysis, it would seem that Disney is currently overvalued. And even if we were to predict that, or just assume that the growth rates for Disney for years 1 through 10 just stayed consistent at about 37 to 38%, the intrinsic value per share based on Disney's current projected free cash flow, as well as the amount of debt they currently have on their business, comes out to be about $86 per share, which would still mean that Disney is looking at a bit of an overvaluation at the moment. We can see that from these metrics down here that they're currently trading at 141 times earnings, which is pretty big. And then they're also trading at about 4 times free cash flow because they have a market cap of 280 billion, and their intrinsic value per share using the original growth rates that we had comes out to be about 4 times the intrinsic value at the moment. So depending on the different growth rates that someone using a discounted cash flows model could use, they might be able to get a different intrinsic value calculation for Disney's business as a whole. But based on these values, it seems that Disney is currently sitting at a bit of an overvaluation. But I would love to know what everyone who's watching this video thinks. If they think that Disney is a buy or a sell at the moment, let me know in the comment section down below. Like, subscribe, all that good stuff, and I'll see everyone in the next one.